everybody. This is Ellman, the blue collar investor, with today's option selling question of the day. And today's question comes from Ed. Alan, I recently sold an in-the-money strike and share price shot up way past the sum of the in-the-money option and the strike price of that option. I then bought back the in-the-money option and sold another in-the-money option, one increment less in strike price than the one I just bought back. So he rolled down. This does two things. I do not lose money on the option, number one, and number two, the total stock price plus the option premiums will be closer to the current market value of the stock, and therefore I will make more money than not acting. What is your opinion of this strategy? Thank you, Ed. Well, there's a whole lot in there, isn't there? So let's first summarize Ed's hypothesis. Then we'll break it down and we'll come to some kind of conclusions as to whether or not this is a good approach, and if not, what another approach might be that might be even better than this one. All right, first let's summarize Ed's hypothesis. We're going to buy a stock and sell an in-the-money call based on overall market assessment and chart technicals. So in essence, when we use an in-the-money strike, we're assuming that the market has a bearish tone to it and or a volatile tone, but we just want the additional protection that the intrinsic value component of an option premium will give us when we sell an in-the-money strike. Then what happens after we enter our position, the price of the stock goes significantly higher. At that point in time, Ed suggests buying back the initial in-the-money call option and then selling the next lower strike price, rolling down, which will then have a larger premium attached to it. So then, of course, the question is this a valid strategy that will enhance our overall portfolio returns? So that summarizes Ed's hypothesis. Let's break it down, and let's actually look at a real-life example with Intel Corp. The ticker is INTC, and we'll look at an option chain here. And we see the ask column for the 45 strike on the right side, the far right column, generates an ask premium of $3.80. And the $43 lower strike has a bid price of $5.75. Remember, we always buy at the ask and sell at the bid. So that's the option chain now for Intel Corp. And what we're going to do next is we're going to examine the actual numbers and break it down and see if this makes sense. So the option credit, 575, which is what we generate for the lower strike in the brown row, minus the 380 yellow row, generates a credit, a total credit from rolling down of $1.95 a share, $195 a contract minus small trading commissions. But now let's take a look at what that does to the maximum value of our stock. When we buy back the 45 call and sell the 43 call, that means our shares cannot be worth more than $43 per share because of our contract obligation to sell our shares at that price. So although we do get a credit of $1.95 on the option side, we have a debit on the stock side of $2. Net, we have a debit of 5 cents a share, $5 a contract plus trading commissions that we will lose by rolling down. So you could see here that Ed factored in the option side correctly, but neglected the stock side, which is going to wash away any option credit and frequently end up in a net loss by doing the trade. So obviously, we're going to eliminate any strategy that involves a guaranteed loss. Now, what might we do in a scenario like this that Ed describes that would actually work and enhance our portfolio value? And that's where the mid-contract unwind exit strategy comes into play. This is best used when the share price rises significantly and the time value of the premium approaches zero. That by definition is what a deep in the money strike is. So in this particular case, as share price rises significantly, the strike price goes deeper and deeper in the money. And while the total premium will increase because of intrinsic value, the time value component of that premium will get lower and lower and start approaching zero. So, in this particular scenario, with Intel trading at $48.76, the cost to close is $3.80. Let's break that down. Of that $3.80, $3.76 is intrinsic value. That's the difference between the current market value of $48.76 and the 45 strike, which is initially in place. So, if the intrinsic value is $3.76 and the total premium is $3.80, that means only 4 cents is time value, $4 per contract. The question is, if we close our position completely, option and stock, and use that cash to enter a different position with a different stock and a different call option sold, can we generate more than 4 cents a share? Well, if that occurs mid-contract, that should be very, very easy. And that's the value of the mid-contract unwind exit strategy. So let's feed that information now that we have into the Unwind Now tab of the Elite version of the Ellman Calculator. Now, for premium members, the Elite version of the Ellman Calculator is available for free in the Resources Download section of your member site. For those of you who are not members, the Elite Calculator is available in the BCI store. Okay, so let's put first the information on the left side of the spreadsheet. You could see that originally the stock was bought at 46, the 45 call in the money call was sold, and the option sale price was $2. Those factors are really unimportant in whether or not we should roll down or use the mid-contract unwind exit strategy. What is important is that the current price is $48.76. We know that we have the 45 strike in place, and the cost to close that 45 strike is $3.80. So once that information is filled in, we then look to the right side of the spreadsheet, and if we scroll all the way down to the bottom, we could see the time value cost to close, which is $4 per contract per 100 shares, which is less than 0.1%. So it's a very, very small time value cost to close. This is a precise scenario when we would implement the mid-contract unwind exit strategy. We would then take the cash from the shares that we sold and use that cash to purchase a different stock and sell a different option midway through the contract. And if possible, I would favor an in-the-money call option. This way, we're preserving the capital that we generated from the sale of our initial option. So it's not essential we use an in-the-money strike when we use the mid-contract unwind, but for me, it's preferable. All right, so for more information on this mid-contract unwind exit strategy, for those of you who have the classic edition of the Complete Encyclopedia, look to pages 264 to 271. And for those of you that have volume 2 as well, look for pages 243 to 252. We have several examples detailed on how to implement this wonderful strategy where we can actually generate more than a maximum return with the same cash, a different stock, in the same contract month. So to summarize today's question, what we're going to do is we're going to tell you that when share price rises significantly, leaving the original sold option in the money and deeper in the money than original, rolling down will not enhance trade results. It just won't work because the decline in share value will wipe that out. Generally, you're going to end up in a net debit situation. But the time value cost to close should be looked at because, again, as the strike moves deeper in the money, or stated differently, as the stock price continues to accelerate, the time value component of the premium that it'll cost us to close the position will start approaching zero. And as it does, we can close our position and use that cash to then generate a second income stream in the same month with the same cash to make an even higher return than the maximum return we would have had we only stayed in the one position. Now, this is actually Ask Alan video number 159. We've been making these for years and years and years, and for the last several years we've made it a point to make a new one every single month of the year. These videos are available only to premium members for the entire library of Ask Alan videos. We do have a couple on our YouTube page and a couple on the general site, but the entire library is available only to premium members. Just go to the member site and scroll down on the left side. You can see the screenshot here for the Ask Alan videos. It's located below the Blue Hour webinar series, which is also available only to our premium members. So this is an educational tool that you should absolutely take advantage of, because these are real life trades made either from my own portfolios or from those of some of our members. So they're very valuable because they're practical and they show how to manage a trade, both good and bad. So I want to thank Ed for his great question, and of course I also want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.